Good day, and thanks for joining us for our Crop Outlook Update. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me today are my colleagues, Dr. Michael Langemeier, who's the Associate Director of the Center for Commercial Agriculture and a Professor of Ag Economics, and Nathan Thompson, who's an Associate Professor of Ag Economics here at Purdue. Well, there's a lot of information to talk about, and of course, this is following USDA's release of the World Ag Supply Demand Estimates, and let's just kind of review some of the highlights that were on the report last week. First of all, no changes to the corn balance sheet for the 2021-2022 marketing year. That leaves corn ending stocks estimated for this year at about 1.44 billion bushels. May is the first month, however, that USDA publishes estimates for the 2022 crop balance sheet for corn. And they did make some changes there relative to at least what people were expecting prior to the report's release. So they backed away from the trendline corn yield estimate, which they initially projected back at the World Ag Outlook Forum in February. Earlier, they were at about 181 bushels per acre. They are currently using 177 bushels per acre. That's the same as it was last year in 2021. And as we'll see later, is still a record yield. That gives us an estimate combined with the planting acreage estimate coming out of the Planting Intentions Report of about 14.46 billion bushels. That's down from last year's 15.115. Ethanol usage in the 22 marketing year is estimated to be about the same as it is in the 21 marketing year at about 5.375 billion bushels. And they did reduce exports by 100 million bushels, so leaving it at 2.4 billion bushels for the 22 marketing year compared to the 21 marketing year, which is still at 2.5 billion bushels. The projected carryover, the net of all of that, winds up being 1.36 billion bushels, down 80 million bushels from the 21-22 crop year. And of course, all those numbers are subject to change as we progress through the course of the marketing year and certainly as we move through the course of the summer with respect to production. There were also some changes in USDA's corn trade projections in the May WASDE estimates, and those are of more interest maybe than normal this year because of the uncertainty created because of the situation in Ukraine and also what's going on in South America with respect to weather problems. So changes in the 21-22 trade matrix, small increase in the major exporters' ending stocks. They raised Argentina's but reduced Brazil's. And then there's a small increase in the Ukraine carryover estimate compared to the April estimate, which was down, changed substantially prior to the estimates that they were publishing before the war got started. If you look at the 2022-2023 crop year trade matrix, world ending stocks expected to increase modestly. Smaller ending stocks, as we just indicated, in the U.S., but a big rebound expected in Brazil based on a large expected production increase in South America for the 22-23 crop year. And then if you look at Ukraine, they've got production down a little over 50%, I think 54% compared to 2021. But the export challenge there is still with us, and of course that's going to have a positive impact on those ending stocks. So just a lot of uncertainty as to the availability of those ending stocks. So let's kind of turn our attention and focus on the domestic market. And I know, Michael, you've been looking at this pretty closely. This is the map of corn planted acreage coming off the intentions report released at the end of March. And, you know, through last week, through the 8th of May, and we're recording this Monday afternoon before the report comes out later this afternoon, through the 8th, just 22% of corn acreage was planted in the U.S. and some uncertainty as to with respect to how much was planted last week. At the end of the week, Thursday, Friday, there was some optimism about those numbers really bumping up quite a bit, but there was a fair amount of rainfall that moved through a good chunk of the Corn Belt over the course of the weekend. So it's really a little up in the air in terms of how much has been planted, right?
Yeah, it certainly is, and particularly in North Dakota, Minnesota, and Wisconsin, the planting was way behind. And so it'll be interesting to see what the report looks like this afternoon. And that's one of the primary reasons I think they reduced the corn yield estimate.
Yeah, and it's going to be very interesting to see how this shakes out. Already some discussion taking place of the possibility of seeing some prevented planting acres in that northern part of the Corn Belt, right?
Definitely, that would be the case, and if that's the case, obviously that's going to make the ending stocks even tighter.
Yeah, so it's something the market's going to be paying very close attention to for the next certainly the next few weeks. So, as Michael mentioned, that slow planting pace is probably what led USDA to back away from that trend yield estimate that they'd published earlier at about 181, or at least suggested they might be using. That 177 is a new record, just barely compared to 17 and 18. I think those crops were both between 176 and 177. So pretty close to what we saw in the 17 and 18 crop years, but still a very high yield number relative to history. And a lot of risks there, Michael. It wouldn't take much in terms of pulling that yield back to make a difference on that balance sheet, right?
Yeah, really, the risk is on two sides. Obviously, the acreage, if we have more prevent plant, the acreage is going to be lower, but also this yield. I mean, I was doing some trend analysis, and I was coming up with a trend of 179, and that's with good weather. And so certainly we could see something lower than 177 as a fairly strong possibility.
Yeah, you wouldn't have to have a disaster if, I mean, for example,
No,
if
even
you
if you
take
took a bushel or two off.
Yeah, or maybe 5, you get down to like 172, which isn't, by historical standards, wouldn't be that unusual. And so things could tighten up. So a lot of uncertainty there on the yield side. Well, as I mentioned earlier, the production numbers were at 14.46. That's down somewhat compared to last year. Most of that's because of the acreage number, obviously, with the yield basically being held constant with last year's level. So some risks there. It's still a big corn crop by historical standards, although it's not a record yield by any stretch, so a record production by any stretch. If you look at corn ending stocks, USDA's projection for the 21 marketing year is currently sitting at about 9.6%, and their initial projection for the 22 crop year is at 9%. And I have to say that the risk on both of those really is probably with respect to maybe seeing those numbers come down. What do you think, Nathan?
Yeah, I would agree. I think that there's definitely, an expectation that we could see those numbers go down. And again, that has a big implication in terms of how markets are going to respond to that with tighter ending stocks.
Yeah, I mean, as I look at it, I mean, USDA is essentially assuming, as I would too in their place, that we're going to see the acreage planted that was on the planting intentions report. We've got yield at 177, and the risk, I think, is that yield comes in maybe a little lower than that 177. The risk is that the acreage comes in a little bit smaller, and in both of those cases, it would point to tighter ending stocks than what they've suggested, at least so far. No guarantee it's going to be tighter, but that would be the risk that I'd be thinking about the most. A lot of interest, I think, with respect to what's taken place with respect to corn usage going into ethanol. And, you know, we were talking before the program, a year ago, if you had told us, any of us really, that you could see corn prices flirting with $8 a bushel and still see positive margins in the ethanol industry, we would have been skeptical, to say the least. And yet that's exactly the situation we're looking at. Those ethanol margins are still positive. They are well below where they were last fall, particularly around that Thanksgiving time frame, but still positive. And if you look at usage so far, it's still up about 9% this crop year versus the prior crop year. And so USDA's estimate looks like it's in the ballpark. Based on usage so far, maybe they're a little bit on the conservative side. I think the grind is maybe running a little bit ahead of their pace, but still not too far off. And you know, looking forward with respect to these very strong oil prices and gasoline prices, I think prospects for ethanol usage continuing pretty strong or pretty good. If you look at the major exporters' ending stocks, the 5 countries that really predominate in terms of exports, they're tight, but maybe not as tight as we've seen in several years. Going back to 2011, 2012 crops, we had those ending stocks in the major exporters down below 4%. USDA is still projecting this year at 4.4 and next year at 4.7%. But those ending stocks could be tighter than they really appear. So first of all, I think a lot of people in the private sector think the USDA estimate for Brazil is probably still too high with respect to production. That would tighten those numbers up. And then, and just to put that in context, Brazil accounts for about 14% of those major exporter ending stocks. And Ukraine, of course, accounts for about 15% of estimated ending stocks. So if you think of it from that perspective, both of those could tighten more than what we're suggesting here. And that could pull the 21 ending stocks down below 4% without too much trouble. And of course, tighten things up a little bit more in 22. And again, I have it, my inclination is to say that the risk is that the ending stocks are tighter than what USDA is currently projecting. But admittedly, there's a tremendous amount of variability there in terms of estimating what's going to happen in Ukraine and how many of those bushels are actually going to be available to the marketplace. It's still very, very unclear how that's going to shake out. Well, where does that leave us in terms of marketing year averages? USDA is at 590 for corn for the 21 marketing year. And this was their first estimate for the 22 marketing year, and they're at 675. That is slightly below where we were in 2012. But based on the discussion we've had so far, I think the risk is that it could wind up coming in higher than that. Do you agree with that, Michael?
Yeah, I think definitely. If you look at the fall futures, December futures, for example, it's considerably above that, and so that leads me to believe that there's quite a bit of upside in this corn market.
So Nathan, you've been looking at cash opportunities and storage opportunities. Let's talk a little bit about that.
Yeah, so just kind of start off looking at some forward contract bids for corn at a location here in central Indiana. And so the darker gold bar that's running across the top there, that would be the current cash bid that they have in May, June, and July. And then the two other lines that are running below that, so the lighter gold line and the gray line there, are what I'm calling an implied break-even price. So basically, if you're going to forego the $7.89 bid for delivery now, how much would you actually have to sell that corn for in June or July to cover both your storage cost and your opportunity cost? And those are two different scenarios. One for an on-farm storage scenario where I'm assuming 1 cent per bushel per month of storage cost, as well as an opportunity cost at 6% APR. And then a commercial scenario which would have a little higher cost structure, so 4 cents per bushel per month, and then that same opportunity cost. And so what you can see in the chart here, which is different than what we've seen in quite a while, is that the current cash bids are above my implied break-evens. Meaning, if you were going to hold on to corn today and forward contract to sell that and deliver it to a particular elevator at the $8.04 in June, that would be more than what based on my assumptions, more than the cost that you would incur to get it there. So that would be a profitable decision. For the longest time, more than 12 months, I would say, we have not seen this chart show a positive return to a storage scenario for those forward contract bids. And again, there's lots of reasons why that is. But the one interesting thing here, I think, as it relates to kind of where we're going to go here in the next couple of minutes, is that's all an improvement in basis. So that May bid and the June bid are both based off of July futures. And so the improvement from 789 to 804, that 15-cent increase is all an improvement in that basis bid from the May to June delivery. And so, I think that's really interesting. That 15 cents improvement in basis in 1 month is obviously going to give you a profitable return to storing, because you don't have that much cost wrapped up in a month in storing that grain. And so that kind of leads us down this road of, okay, well, what are we seeing going on in terms of basis right now? So on the next slide here, we're looking at corn basis in central Indiana. The blue line is the historical 3-year average for that region. And again, we're looking at July basis going all the way back. So this is not a rolling nearby. This is looking relative to the July 2022 futures from last fall through now to give us a kind of consistent look at one contract. And what you can see is, we had a little bit of a spike in basis for corn back in the beginning of March. Some of that had to do with what was going on in Ukraine and shifting kind of grain flows. But since that has kind of settled down and is running, I'd say 10 cents under that historical 3-year average, but really following the same pattern that we would expect it to see, just slightly weaker than maybe the historical average. On the next slide, we look at corn basis in southwest Indiana. Okay, so maybe a little more indicative of what's going on in the river, maybe some of what's happening in export markets. And you can see quite a bit different story. We were running quite a bit weaker than that historical average, but have seen basis really strengthen here in just the last couple of weeks and get back near that historical average. And so, again, a lot of that probably being indicative of what's going on in export markets. The other thing that I should point out, we talked about earlier, is, I'm focusing here on the last 4 to 6 weeks of the chart. But it's interesting at this point in the year to take a look back at how much improvement we've had in basis over a longer period of time, right? So we started out 30 cents under back in the fall, and now we have basis that's, 10 cents over. So we're talking about 45 cents or so improvement in basis throughout the year. That's really strong improvements in basis. That would certainly, in a storage hedge scenario, result in some profitable returns. Now, if you wouldn't have hedged, the improvements we've seen in futures would be much larger than that. But again, for someone who implemented a strategy like that, something we talk about quite a bit, we certainly saw a year with good basis improvements. So the other thing that I think is interesting here, so again, I'm kind of acknowledging this strengthening of basis there in Southwest Indiana the last couple of weeks, is to compare that, because again, the basis tool is looking at these regional averages. So everybody in Southwest Indiana all gets lumped together. That includes the river market, but also includes inland terminals as well. On the next slide here, I've looked at and pulled out just river terminals along the Ohio River in both southern Indiana and southern Illinois. And so what you can see in this chart, again, is a pretty sharp increase in basis at those terminals, again, in the last 4 to 6 weeks. Again, that is pretty consistent with what I showed you on the chart from the basis tool, but just kind of makes the same point of this kind of strengthening of corn basis recently, likely driven by export demand given kind of the locations.
So, Nathan, when you look at that chart, you can see the bump that took place with respect to export demand right when the war broke out in Ukraine.
That's right.
And then that kind of went away, and that showed up in the other chart as well, right?
Yep.
And now we've climbed back. We're basically looking at basis levels that are very, very close to what we were looking at in late February, just as the war broke out, right?
That's right, yeah. I mean, we saw that kind of spike up pretty quickly there, and then it really dissipated as quickly as it went up. But now we've seen this kind of more steady strengthening, really getting us back in line with where history would say we would be for this time of year for those markets. So yeah, very, very strong basis opportunities right now. So then here we're looking at it from a slightly different angle. This is the Indiana ethanol plant basis, an index, right? So I've just averaged together all of the ethanol plants here in Indiana, what their basis numbers are. Again, there's a lot going on here, but it really is important to kind of piece this out because so much has happened in these markets in the last several years. And so just quickly, I've got several different lines there because really the last couple of years have been pretty exceptional in terms of some events that have happened that have impacted basis at those ethanol plants. So 18, 19, so in the spring of 19, we had planting issues, a lot of preventive planting. That caused basis to really run up at those ethanol plants in the Eastern Corn Belt. Trying to secure corn, given that we weren't getting a lot of it planted. In 1920, obviously the spring of 20, you could see the red line there. We get this huge drop that had to do with COVID and the impact on gasoline demand. And then the purple line would have been last summer, so the summer of 21, we saw a huge run up in corn basis at those ethanol plants. So really, with all of that as context, what I really want to focus on is the blue line that runs through the middle there. That's the average of 15 to 17, which I'm calling the last kind of normal period of time. And then the black line being what's going on recently. And I think the most important thing to pay attention there is, again, similar to what I was showing you some of those other corn basis charts. Basis at ethanol plants has also been strengthening pretty consistently over the last 4 to 6 weeks. And again, going back to the comment you made earlier, somewhat surprising given where corn prices are, that ethanol plants are continuing to be profitable and continuing to bid strongly for corn even with futures prices where they are.
Yeah, and I think what's going on there, Nathan, is the fact that as you look at it, they've still got a positive margin, not nearly as positive as it was last fall for a while, but they've had to increase their bids to pull the corn in, right?
They have, yeah.
We're kind of in this environment now where users are having to bid up the basis to pull corn out of storage. And that's especially true during the middle of planting season, right?
Yeah, it is. I mean, I've seen lots of things recently where, people need crop, but farmers, given what we've been seeing, being behind with planting, when farmers want to be in the field, they want to be in the field. They're not answering the phone to go deliver corn to the ethanol plant, right? And so certainly it's time of year when we can see some pretty volatile jumps in basis. So then kind of just to close out some of the thoughts here on the corn crop and some marketing opportunities, I wanted to shift my attention a little bit to new crop opportunities and have folks start thinking about, the 2022 crop. We talk about frequently the seasonality in new crop corn futures. And so every once in a while, I think it's useful to throw this chart up just to give people a visual of what we're talking about. So just briefly, so this is an index. So basically I say, okay, what was the corn price in January? I'm going to set that to 100%. And on average, if the number on the chart is above 100, that would mean that we typically see corn prices increase above the January 1 price that time of year. For numbers that are below 100, that would mean on average, we typically see corn prices at below the 1st of January for that time of year. So what you can see is that basically the beginning of April through the end of June is the time where we see the most strength in the new crop corn futures market seasonally. Again, that's not a guarantee that that's where the market puts in its high, but on average, right, that's where we most frequently see the market put in higher prices. And so we're kind of right in the middle of that time frame. We've been talking about that for several months, have people looking forward. And so again, there's lots of reasons to think that corn markets can continue to strengthen going forward. But if you're just basing kind of your decisions on kind of historical patterns, there's a lot of reason to think that you'd want to be making some decisions now. And again, on a portion of that new crop, you might want to, price some of that. I certainly wouldn't say all of it by any means, but this is the time of year when we would expect to see some strength in those futures prices.
And so let's just think about why that might be. I mean, the marketplace this time of year is a little bit uncertain about acreage.
Right.
Obviously uncertain about yield.
Yeah.
And as long as that's the case, you've got a risk element essentially bid into those prices. Yeah. And then on average, what it says is, as time goes on, most years we get the crop planted. Most years we have yields that are commensurate with what the expectations were earlier in the season. And when that happens, we see that risk premium essentially erode as you head through the course of the season. So what we're really talking about here is taking advantage of that built-in risk premium that usually occurs. And the chart doesn't tell us whether or not this week is the week or next week or the week after. It just tells us to be very, very alert during this time frame, right?
That's right. Be paying attention, right? If you're going to be making some new crop sales, this time of year would, on average, be a good time to be thinking about that. And again, current futures prices are very strong, so that would be a good decision. That doesn't mean they're not going to go up from here, but it would certainly be a good time of year.
Michael, we were talking about this earlier before the program, and you were comparing offerings to expected break-evens on your budgets here for a corn-soybean operation.
Yeah, break-even right now is at 560 to 570, and you start looking at corn, 720, 730, that's got to be pretty attractive.
And I want to emphasize, when you say your break-even, that's including the elevated costs that we're experiencing, right?
Yeah, break-evens obviously have increased about 25, 26% from last year, but even with that incorporated, we're still looking at some very, very profitable corn opportunities.
So, the implication is if you haven't started on the 22 crop marketing, this might be a reasonable opportunity. No guarantee this is the high point or anything like that, but from a profitability and a risk management standpoint, it makes a lot of sense, right?
That's right.
I mean, the essence of risk management is all about the idea that we can't predict the future that accurately, right?
That's exactly right.
So that's why you want to split things up a little bit and maybe lock in some positive returns when they present themselves.
And that's exactly the point that I really wanted to make with this slide here, and that is we don't know what the price is going to be, right? So this is the FarmDoc price discovery tool that's available on the website there on the slide. Basically what this does is uses current futures prices and volatility to predict the distribution of what December 2022 corn futures could be at expiration in December, right? And so you can see kind of on the right-hand side there, price at expiration and the probability that we'll be at that price or below. And so again, there's upside potential between now and December, and there is downside potential between now and December. And tying back to what you asked Michael about the break-even prices, I tried to kind of just back of the envelope think through what some numbers might be that would be relevant for comparing to his break-evens. So if you look at corn price, say, goes down to $6. Corn futures price goes down to $6. If we take basis in the fall of, say, 25 cents under, that would be pretty average based on the basis tool and based on some current bids. That puts you at $5.75 cash price, okay? That's pretty close to what Michael mentioned in terms of break-evens. We've got a 20% chance that we would be below that level, right? So a 1 in 5 chance that we could be below that. Now, again, that's 4 out of 5 that we're going to be above that, and that's good. But just to give you some context for how good current prices are relative to, we'd have to see a pretty big decline in prices to start approaching those break even. So again, you don't want to price everything today, but you certainly want to take advantage of the opportunities that the market is giving us because they are very favorable, even in light of cost increases.
And one of the things that I've noticed by looking at this tool on and off over the years is the variability or the difference between the low prices and the high prices really increases as the stocks to use gets tighter. Mm-hmm. And so this is a very, very wide set of prices. It's because of the low stocks to use.
Yeah, that's a good point.
Yeah, that's a good point.
And it just means that we're increasing risk. And risk is on the upside and the downside. We always got to remember that.
Yep.
Yeah, there's not too many times in the past, if you went over the last, say, 20 or 30 years, where you'd see a $2 spread from top to bottom on that chart, right? So,
no, that's unusual.
Yeah. All right, let's turn our attention to soybeans a little bit. Some key changes to the soybean balance sheet. USDA did increase their export forecast for the 21 crop by 25 million bushels. That's the second month in a row they've done that. The new total is now 2.14 billion bushels. That pushes down the ending stocks estimate by 25 million bushels, and now they're at 235. They were at 260 last month. And then, like corn, this is the first month for the 22-23 crop balance sheet. USDA did stick with basically their trend line yield estimate for soybeans, so unlike corn, they didn't pull the number back relative to what they were talking about back at the Ag Outlook Forum in February. They left it at 51.5 bushels per acre. And they use the acreage from the planting intentions report. And when you do that, you wind up with production estimate of about 4.64 billion bushels for the 22 crop. That's up not quite 5% versus 2021. Initial pass-through on the balance sheet, they're forecasting somewhat larger crush, somewhat larger exports, but that still leads to an increase in the projected carryover from the 21 crop year to the 22 crop year. They wind up at 310 million bushels versus 235 as their current estimate for the 21 crop year. If you look at some changes to their world soybean trade matrix, they held Brazil's estimated harvest for the 21-22 crop here this spring at 125 million metric tons. I have to say that's higher than many of the private estimates that are out there. There's quite a few private estimates that are smaller than that, some of them a little bit smaller, some of them a lot smaller. So just some variability there. They did reduce Argentina's estimate slightly, I think down 1.5 million metric tons to 42 million metric tons. And then looking ahead to 22-23, a big increase expected in production in Brazil, jumping up to 149 million metric tons, up from that 125 this year. And then Argentina expected to increase to 51 million metric tons versus 42 this year. And the result would be a fairly large increase in major exporter ending stocks rising to almost 53 million metric tons. That's a rise of about 30% compared to this year's major exporter ending stocks estimate. If you look at the soybean numbers, we were talking about this a little earlier today before the program, that 4.64 estimate for soybean production is a new record for the U.S. And one of the things that really strikes me about this chart, looking at it over time, it wasn't too long ago that basically soybean production in the U.S. was hovering between 3 and 3.5 billion bushels. Now we're kind of in this 4 to 4.5 billion bushel range. The growth in soybean production has not resulted in what I would characterize as burdensome surpluses. Estimates of usage keep going up as well, right? So we're having a little bit of a tremendous amount of growth in soybean usage over time and keeping those stocks relatively tight. So despite that expectation for record production, the carryover is going to remain. USDA's current estimate for the 21 marketing year is just over 5%. There's been some variability in that estimate as we've moved through the course of the marketing year. I remember last summer we were in the ballpark of about 4% for a while. Then we got up close to 9%. Now we're back down to 5%. The initial projection for the 22 marketing year is just a little under 7% at 6.7%. All of those numbers are relatively tight by historical standards. And the thumb rule I continue to use is anytime you're below 10%, you're looking at a relatively tight carryover. And Michael, as you mentioned with corn, that gives us volatility in prices, right?
That's definitely the case.
And we'll see that here in a bit. If you look at the exporter ending stocks, the major exporters, and just for, kind of remind everybody, there's really a small number of major exporters, right? Obviously, the U.S. is in there, Brazil, Argentina, and then Paraguay. And Paraguay is a pretty small player relative to everybody else in there. So it's really 3 countries that dominate this. Those major exporter ending stocks for the 21 marketing year are currently projected at 13%. Given the big expectation for production increases, especially in South America in 22, bumping up to 16%, at least based on that first pass. If you look at that 13%, that's tighter than we were back in that 2011, 2012 timeframe. And, I think a lot of uncertainty there with respect to just how tight those stocks are going to be. I think, once again, a lot of folks think that USDA could wind up tightening that ending stocks estimate for the 21 crop. I would not be surprised at the end of this marketing year for that ending stocks number to actually fall below 200 million bushels. So we'll see how that shakes out, but it's a tight situation out there.
Even the 16% is a little surprising, given what you said earlier. We've got a major increase in acreage in the U.S., major increase in production in Brazil, and we still only have 16% stocks to use. And so it just goes back to what you're saying about demand. Yeah. Demand is so strong.
Yeah, and of course, one of the things that's taken place there is this tremendous increase in demand for soy oil, right?
Yes.
And a lot of that's about renewable diesel. So USDA is forecasting the highest marketing year average soybean price since the 2012 crop year. They're at $14.40 for the 22 crop, $13.25 for the 21 crop. And as you look at it, I think you have to ask the question, should we be making some decisions, right, with respect to soybeans? So let's take a look at that, Nathan.
Yeah, so let's start kind of at the beginning here, looking at old crop. So these are forward cash contract bids for the next couple of months. So again, the dark gold line running across the bottom there is the current cash bids. The other 2 lines, the lighter gold line and the gray line, are my implied break-evens again. So if you're going to forego the 1667 delivery in May now, how much would you have to sell soybeans for next month or 2 months from now to cover your both storage cost and opportunity costs in that on-farm and the commercial storage scenario? So again, unlike corn here, those current bids aren't really even covering our storage and opportunity cost. But again, this is a useful exercise for folks that do have old crop and are looking at forward contract bids or looking at, holding on to those soybeans for the next little bit. What would you need to be selling that for based on your cost structure in order to make that a profitable decision? Again, the other thing here, and we can talk about this more maybe when I get to the basis slides, but we're at a point in the year where basis just gets kind of crazy. And soybean basis, I'll show in a minute, is kind of gotten to that point where I think there's going to be a lot of volatility here over the remainder of the crop marketing year. But as you're looking forward and making those decisions, if you do have old crop soybeans, this would be kind of a structure to put in place to think through those decisions of holding on to that into the summer months. So with that in mind, looking here at soybean basis in central Indiana, you can see again that's been running maybe 25 cents below that historical 2-year average, so quite a bit weaker these last several months. But again, if you look at the whole chart there, we've seen strengthening from 75 cents under in the fall to today. We're at what is that, 0. So 75-cent increase in soybean basis between the fall and now in central Indiana. On the next slide, we'll look at soybean basis in southwest Indiana. Again, starting to maybe reflect a little bit of what might be going on in export markets there along the river. So you can see not quite as weak as what we showed in central Indiana, probably more in line with that 2-year average and maybe strengthening a little bit here, but really just following that historical pattern. And so part of what got me thinking here was, I'd read some things, Jim, you had sent me a few things talking about kind of the pool that was happening between soybean processors and export markets. And so that led me to think a little bit about, okay, well, what is going on at these processor markets? Start here. Let's start with more of the export market. So this is soybean basis at the river terminals, again, in southern Indiana, southern Illinois, along the Ohio River. And so what you can see is that wasn't really reflected in my chart from the crop basis tool. Again, that's a regional average. There's a lot of numbers that go into that. So when I looked at it this way, you can see this pretty big jump in soybean basis along those river markets here. The last 4 to 6 weeks, we've seen that up, 30, 35 cents, pretty big increase. And then again, I wanted to compare that with what was going on at soybean processors. And so I was able to go into the basis tool and just pick out the 5 or 6 soybean processors in the state of Indiana specifically. So this is soybean basis at those soybean processor locations. And again, you can see this kind of big jump here in the last several weeks in soybean basis at those processors. And so what we're seeing is this tug of war, right? People are maybe busy planning and not wanting to move soybeans, or maybe just old crop beans are just not as easy to come by. And so processors, which have really strong margins right now, are wanting those soybeans, bidding up their basis. Exporters, on the other hand, right, have opportunities to sell those beans. They're bidding up basis. And so we kind of have this tug of war. And I mean, I'm expecting soybean basis to strengthen quite a bit here through the summer, or at least get volatile. It could be go one way or the other. But I think there's a lot of upside potential. And what the market's currently telling us is there are people that are looking for beans that can't find them.
Yeah, the soybean basis story is different than what you showed for corn.
It is.
So in corn, you looked at a situation, particularly at the river markets, where we were back to about the levels we were when the war broke out in Ukraine. And of course, the war in Ukraine didn't have as big an impact on the soybean market as it did on corn. But if you look at what's taking place at those river terminals now, this is the strongest basis of the year by a wide margin, right?
That's right.
And that's making this little tug of war between the processors and the export channels, right?
That's exactly what it is, right? And so they've, as basis has increased, those processors have had to increase their bids to make sure they can get access to those soybeans.
So it's going to be very volatile.
It is going to be interesting. So again, shifting focus to just thinking about some new crop opportunities. We talk about these seasonal patterns all the time. This is the same setup as what I showed for corn. So again, this is an index. Anything above 100 would mean that on average prices that time of year would be higher than what we see the first week of January. Below 100, prices that time of year would be lower than the first week of January. And so again, the timing here is slightly different than that seasonality in corn futures chart, where we see the highest soybean prices on average a little bit later, maybe end of May into July. And so, we're maybe starting to approach this period where we tend to see seasonally high soybean prices. So again, the point that I want to make here is just showing the chart, getting people's attention to start thinking about this might be a time of year, this would be a time of year historically, where you would want to be thinking about pricing some new crop soybeans and locking in what would be, on average, seasonally high prices.
So that chart does look different than the corn. So a couple of things strike me about this versus the corn. So on the corn chart, if you decided to do some pricing earlier in the year, that really wasn't too much different than it is in this time of year. Maybe not quite as strong, but still not too far off.
Yeah.
The soybean chart is much weaker earlier in the season than the corn chart is. And I think that's probably tied, at least historically, based to what's going on in South America.
That's exactly right, yeah.
Now that South America's become a more important corn producer, that relationship could change maybe going forward. So this is going to be interesting to monitor this going forward, see if we start seeing some changes in this. But in both cases, both the charts really speak to the idea that this is a time of year when you should be thinking about doing some pricing of new crop, right?
Yep.
One of the things I noticed right away when you showed this chart is the seasonality is not as pronounced for soybeans. Just different markets. I think that low month for corn was like 94%. It's 99% for soybeans, and so it's not as pronounced.
Yeah, good point. So you've taken a look at the price discovery tool for futures as well.
Yeah, so again, looking at kind of a distribution of that November 2022 soybeans at expiration. You can see quite a range, as Michael alluded to earlier. And so the one kind of number that I wanted to kind of, again, tie back a little bit to the break-even prices, just to give some context, right? So there's about a 20% chance that we could see soybean futures below $13 when we get to expiration in November. Adjust for, say, a 35 cents under basis in the fall. That'd put you $12.60, $12.65. That's probably
very close to break even.
Very close to break even, right? So again, that's just pointing out kind of where current bids are relative to where, we could see downside risk. Again, there's plenty of upside risk here as well. So nobody's saying, go out and sell everything, because I think, with tight stocks, potential, production problems that could happen. I think that there's lots of upside opportunity, but that doesn't mean that you don't want to lock in a certain percentage of the crop at these levels, because it's very profitable compared to what we could see.
This could be your lowest price of the season, right? But if you look at the chart, you guys are focusing on the downside. I look at the upside a little bit.
Yeah.
I think that chart says there's about a 32% chance that prices could be above 16, right?
Definitely.
So,
Yeah, one of the things that's very interesting when you look at corn versus soybeans, though, it's true for corn to some extent that the July futures is higher than these futures, but it's not that big a drop-off compared to soybeans.
Yeah.
And so there is quite a bit of risk of still holding on to last year's soybeans. I think that's the way I would kind of summarize this story.
yeah, good point. All right, Michael, you've been tracking these input prices pretty carefully, and I know you've gotten lots of
Yes.
questions about it.
This is from March 21 to March 22. The latest available information from USDA is March 2022. As we get the new information from April in a couple of weeks, I'll update this chart. And obviously, there's been a lot of volatility and it's basically a surge in farm input prices. The PC deflator off to the far left there is 6.6%. You look at that chart and say, well, that looks relatively low. That's very high inflation. It's just that some of these farm input prices have just skyrocketed. Anhydrous, 145%, potash, 94%, diesel, 76%. That diesel is actually going to go up. We've seen actually higher diesel prices recently, so that's actually going to go up. And even the supplies, machinery, buildings and materials, 14 to 23%. Those are huge increases. And so this chart just does a nice job of illustrating the large increases we've seen in most of the farm inputs, and in most cases, farm input prices have increased more than the PC deflator, and that's not real surprising because some of farm inputs follow general inflation fairly closely. Things like fertilizer, seed, chemicals do not. They have their own market fundamentals.
So, Michael, whenever I see a big number on a percentage change chart like this, I think it's always useful to think about what that means.
Yes.
So, if a percentage change in inflation or the price of an input like anhydrous, if it was 100, that means it had doubled. So at 144.5, it's gone up 1.5 times relative to what it was last
and
year,
depending
right?
when you look at that year to year, you can find periods in that February-March period was actually triple.
Yeah,
This chart is showing more than double.
yeah.
Let's look at where inflation might be heading, and to do that, I'm looking at some Federal Reserve Board projections. I'll comment on what I think about these, but let's get to the numbers here. The last 12 months data available for the PCE price deflator, that's personal consumption expenditure price deflator. That's one common measure of inflation. Another one is the CPI. The CPI tends to run higher than the PC price deflator, and so if you've seen the CPI index in the news, it's been running 8.5%. So there are various measures of inflation, but this is the one that the Federal Reserve Board talks about. The Federal Reserve Board is expecting inflation to decline relatively rapidly as we move into the end of 2022, as we get into 23, 24 in the longer run. I think they're rather optimistic. And so I think inflation could show some more legs than what they're showing here, and so we could see inflation in that 6 to 7% throughout most of 2022 into 2023. And so my main point here is there's a lot of uncertainty related to where inflation is heading. That's going to create uncertainty in the farm input price market all the way into 23.
I guess the other thing to think about, Michael, is if the Fed is right, what does that imply about a recession? To pull inflation back that hard, that quickly, would almost, in my opinion anyway,
almost has to happen as a recession.
Almost guarantee a recession.
Yeah.
I agree with you with respect to optimism there.
One of the reasons we're talking about this is inflation's a key to both farmland, but also farmland, because farmland is a hedge against inflation, but also interest rates, obviously. And so let's review where interest rates have been recently. Looking at April 22 data, that's the latest data available. Federal funds rate was only 0.33%. The 10-year Treasury was 2.75%. The 10-year Treasury is more something that we compare to real estate rates, whereas the Fed fund rate and the prime rate is more to operating loan rate. The prime rate was 3.55%. In early May, the Federal Reserve increased the Fed fund rate about 0.5% or half a percent. That gets us up to about 0.8, 0.9% for the Fed fund rate. The 10-year Treasury increased to over 3% in early May, and the prime rate went up to 4%. Based on what the news from the Federal Reserve Board, they're expecting the prime rate or the Fed funds rate to increase another percentage. That would add a percent to the prime rate, moving that towards 5% if that does happen. The question that Jim asked me this morning, we actually added this to the slide. What does this mean for farm operating interest rates? Well, there's not a direct link between the prime rate and the operating interest rates, but they do tend to move together. And so if we saw a 1.5% increase in the operating interest rate from April, for example, we would be looking at operating interest rates from 6 to 6.5%. That sounds really high, but that's about where we were pre-COVID. If you look at 2018, 2019, Federal Reserve Bank of Chicago, the interest rates were right around 5.756%. So we're going back to where we were pre-COVID. Again, the Federal Reserve Board does not look at forecasting the prime rate. Rather, they look at the Fed funds rate. And so we can apply what the increases in Fed funds rate, what that might be doing to other interest rates, because this is a fundamental interest rate that people look at from a forecast standpoint. They're expecting that Fed funds rate to go up to 1.9%. That'd be the 1.5% increase in 22. That's where I'm getting the 6 to 6.5% operating interest rate. And then they're expecting another percentage increase as we move into 23. Longer run, they're expecting that Fed funds rate to be 2.4%. And so if this all materializes, that means operating interest rate is not heading to 4% anytime soon. We're looking more at like 6%, 6.5% long run.
So, Michael, thinking about your earlier comments about the Fed pulling back inflation, being optimistic in terms of what they expect to do. Let's assume you're right and they're wrong. What does that imply about farm operating interest rates?
The farm operating interest rates, if the inflation is not as tight, we're probably looking at a little bit lower operating interest rates, because because usually you're looking at the real interest rate being positive, obviously, and so if there's not as much inflation pressure, there's not as much pressure for the operating interest rates to be high, and so if the Fed's forecasts are right, we're probably looking more like the 6% or maybe slightly under. If there's more inflation, then we're looking at something 6.5, even higher. If there's higher inflation.
Yeah, that would be at the risk,
Yeah,
right? If the Fed has more trouble slowing down the rate of inflation than what they're projecting, that means they're going to have to be more aggressive with respect to how they treat their balance sheet, as well as what they do with the federal funds rate. Both of those things would point to even higher interest rates than what we've got on the chart so far, right?
Yeah, and I just remember from the early 80s how hard it was to reduce the inflation. Obviously, we were dealing with higher inflation than we're talking about today, but nevertheless, it's difficult. And so all I'm saying is it might take a little longer than what the Fed was forecasting to tame inflation. And so obviously a lot of uncertainty. I wanted to throw in a chart there, from a historical standpoint, what this increase in Fed rate means. 1.9% in 22, 2.8% in 23. Obviously, that's much different environment than what we've seen since the spring of 2020, right after COVID hit. They reduced that Fed funds rate to almost zero. Now we're moving into that environment where we're closer to 18, 19, but we're not going back to where we were in 2007, for example. We had the major crisis in the U.S. economy in 2008. We're not going back to that 5%. We're going back to that environment that we had in 2018, 2019.
So, Michael, you've got this chart starting in 2007, and actually, if you put another couple of decades on, for example, in that chart, it would help it clarify really that the period from 2009 to about 16 or 17 or maybe even 18, that's the anomaly.
Yes.
That's the unusual part of the chart.
Yes.
Uh,
And really what they were trying to do there in 1819, they were trying to change the policy that they had from 2009 to 2017, that anomaly, and they were stopped. Because of COVID, they couldn't continue that policy, so they backed away from that. The economy tanked, and so they dropped that interest rate to close to zero. To try to improve the economy, and so I think all they're doing is they're going back to increasing that Fed funds rate, slowly but surely.
Well, they did two things, right? One is they pulled back on the federal funds rate. The other thing was they increased their balance sheet pretty substantially.
Oh, yes.
So there's two things going on there that were loosening over that time frame, pumping a lot of cash into the economy. Now they're trying to back away from that. And it's a tricky business to do that without having a recession hit. So, all right, let's take a closer look at net farm income, because you've been tracking this pretty closely as well.
We don't need to belabor this slide. I've just updated this slide from last month, and 22 looks stronger than 21 now. And part of the reason why 21 doesn't look better than 22 is remember, I'm following a very simple marketing strategy for corn and soybeans here. Half of the corn and soybeans was sold in late 21. And obviously, we've had rather large increases in prices since the beginning of 22, and so if those that sold most of their crop, their 21 crop in 22, it would be even higher than that $349, and so that's part of the reason why 22 looks better. But it's just unbelievable to me. I say this every month, but it's unbelievable to me that 22 looks that good with our very large increases of break-even prices.
And not only does it look good relative to 21. Go back in
historically.
history.
I mean, I think you'd have to go back to 73, 74
to
see something that good.
You're $100 above where you were in 2011.
Yeah.
Those are big numbers.
And
right?
that long run average at $140, that's not a bad long run average. We've had a good run in production agriculture since 2007. That's economic profit. I don't have economic profit illustrated on this chart, but those of you that loved Econ 101, remember economic profit is profit after we've accounted for all costs, cash and opportunity costs. We've had economic profit since 2007 on average. It's not huge, but it's been economic profit. That's a very unusual period.
Yeah.
And so I think that's worth restating.
The other thing you've taken a look at, which is always of interest, is the relationship between expected profitability for corn versus soybeans.
Yeah, and I realize people aren't going to change what they plant this time of year very easily, unless there's all kinds of planting issues. But it just illustrates how much the market is telling us it wants corn. I mean, we're looking at an advantage towards corn that we haven't seen since 2011. And you remember back 2010, 2011, 2012, corn was the king for a while there. And we're back in that similar period where the market really wants U.S. producers and producers around the world to plant corn.
Yeah, and obviously that's been triggered very heavily by what's taken place in the Black Sea region.
Yeah,
with Ukraine.
that just made it more so. It's probably added $100 to that 22 chart. And it was corn looked good all spring. Particularly once we got to February or March, when we started seeing those increases in corn prices, even before the Ukraine conflict. But after the Ukraine conflict, that just jumped all the way to this. Currently we're at that $200, and so it added at least $100 per acre advantage towards corn.
And just to refresh our memories, I think the first time you did this chart was either in October or November.
Yeah, and it was pretty much break even.
Yeah, pretty much a
coin
toss.
It was pretty much a coin toss, and it's went from that to huge advantage, huge profits for corn.
Yeah. Well, that wraps up our discussion for this month's Outlook. Our next Crop Outlook webinar will be on Monday, June 13th. I think USDA releases the WASDE report on Friday, the 10th of June. So we'll have some new information for you then, and of course there's going to be lots of new information in between now and then with respect to what's taking place in planting and so forth. So details for that webinar will be available at our website, purdue.edu/commercial ag, and of course we'll also be doing some podcasts in between, so you can tap into those as well. So with that, I want to thank my colleagues, Dr. Michael Langemeier and Dr. Nathan Thompson, and on behalf of the Center for Commercial Agriculture, I'm Jim Mintert.